Welcome to the deep dive, where we cut through the noise to bring you the insights that truly matter. Today, we're plunging into a corner of the financial world that might seem quiet, maybe even a bit technical, but its implications are, well, anything but. We're talking about stablecoins and how they, along with some powerful new government legislation, are fundamentally reshaping the U.S. monetary system.
Yeah, absolutely. And for this deep dive, we've really dissected the latest weekly newsletter from the Macro Butler. It's aptly titled, In Stablecoins We Patch. Our mission really is to unpack the core insights from this material, decode some of the jargon, and give you a real shortcut to understanding these significant shifts and, crucially, what they could mean for your portfolio.
Exactly. Prepare for some surprising facts, maybe some unexpected connections, and insights that definitely go far beyond the surface. We're here to help you get well informed quickly and hopefully entertainingly. Okay, so let's unpack this. Washington has been quite busy, seemingly behind the scenes. The Macro Butler newsletter kicks off with a big one, the Genius Act. What exactly is this legislation?
Right. So the Genius Act that stands for Guiding and Establishing National Innovation for U.S. Stablecoins. It was signed by President Donald J. Trump back in July 2025, championed by Senator Bill Hagerty. The newsletter frames this as a pretty significant move for the government to sort of gain influence over what was then a $250 billion stablecoin market. Its core principle. Basically, stablecoins, if they're backed by safe assets like treasury bills and money market funds, well, they're required to settle at par, one for one.
Okay, so mandating their stability by law. But the newsletter seems to hint at a much deeper control mechanism, right? More than just stability.
Exactly, that's the argument. The author argues this effectively creates a, quote, shiny new kind of bank deposit.
Yeah.
And even a new dollar. He likens it to Eurodollars, but on-chain. Now, for our listeners, Eurodollars are basically U.S. dollars held in banks outside the U.S., operating kind of beyond direct domestic regulation. And that comparison is key because historically, Eurodollars created this massive offshore market. Now, the idea is we're seeing an on-chain equivalent, but this time, crucially, under explicit U.S. government oversight.
Okay. Oversight being the key difference.
Right. The Genius Act grants officials powers to, and this is pretty direct, block, freeze, and reject transactions. And it compels stablecoin issuers to act like full financial institutions. So think obligations to snitch, censor, and comply. The Macro Butler provocatively calls this a TSA pat-down for your digital money.
Wow, a TSA pat-down.
Yeah, and suggests it's the friendly, non-threatening face of CBDCs, implementing similar control but doing it through private, licensed, supervised entities, bank subsidiaries, federally blessed non-banks, that sort of thing.
That's a really striking comparison. And the newsletter also draws a fascinating historical parallel here, doesn't it?
It does, yeah. It compares the Genius Act to the Civil War-era National Banking Act of 1863. That act essentially forced banks to buy treasuries to fund the Union war effort. So this historical echo suggests a pattern, maybe, the government coercing private institutions to help prop up its finances. Now, potentially to address issues like, de-dollarization and its own pressing funding needs, it's a powerful point about how old strategies can resurface in new forms.
And here's where it gets really interesting, because beyond Genius, the newsletter points out two other laws that kind of quietly slipped through. Can you quickly break down the CBDC Anti-Surveillance State Act and the Clarity Act?
Absolutely. So the CBDC Anti-Surveillance State Act, it basically prohibits the Fed from issuing a central bank digital currency directly to American citizens, unless Congress explicitly grants permission. But what's intriguing here is the newsletter's claim. It suggests the Fed wasn't even the main force pushing for a digital dollar. Instead, it points to what the author calls the international banking cabal, institutions like the BIS, big commercial banks, figures from the Davos crowd, who apparently dream of killing cash, us. The Fed, in this telling, was more of a reluctant villain.
Huh. So it's not a hard no to a CBDC, but maybe an indirect approach through these regulated private players with the Fed sort of sidestepping direct issuance for now. Is that the idea?
Precisely. That seems to be the interpretation. Then you have the Clarity Act. This one tries to settle that long-standing debate. Is a crypto token a security or a commodity? Which, has massive implications for who regulates it. The CFTC gets commodities, the SEC oversees investments or securities. Crucially, the newsletter points out that if a token matures on a truly decentralized network, think Bitcoin or Ethereum, it can potentially graduate from being an SEC target to a free asset, The source likens it to crypto puberty.
Crypto puberty, okay. And that distinction determines everything stringent securities laws versus looser commodity rules.
Yeah.
Big deal for market viability.
A very big deal.
So, okay, we've got this legislative backdrop. What does all this mean for stablecoins themselves? For those maybe less familiar, what exactly is a stablecoin and why are they suddenly so vital, particularly for investors to understand?
Right. Good question. At its core, a stablecoin is designed to be, as the source puts it, crypto's straight-A student. Predictable, usually pegged to the US dollar, with the theoretical promise of a dollar in reserve for every stablecoin issued,
Yeah.
allegedly. They are just tokenized dollars trying really hard not to freak out. That stability is what sets them apart from, say, Bitcoin's volatility.
And tokenization is the key concept here you mentioned.
Yeah, exactly. Tokenization is just the process of putting real-world assets onto a blockchain. Could be stocks, bonds, bank deposits, even real estate. This creates digital tokens that represent something real. Stablecoins are just the most common example right now, basically making dollars or dollar-backed assets programmable and transferable in these networks.
Okay, got it. So how are these tokenized dollars actually being used day to day, and why should we, especially investors, care about their growing influence?
Well, their utility is expanding rapidly. They're used for things like cross-border payments, often bypassing traditional banks, B2B settlements too, remittances, and they become a real lifeline in some emerging markets where local currencies are unstable, to put it mildly. Now, critics might call them the criminal's Venmo, but supporters see them as a crucial financial rail. The newsletter has a fun line here, calling them the blockchain's version of duct tape. Not flashy, but surprisingly useful.
Duct tape. I like that.
Yeah. But what's really remarkable for investors is the sheer scale. The source notes that since November 2024, stablecoin transaction volumes have actually outpaced Visa's quarterly totals.
Whoa, hang on. Outpaced Visa.
That's what the source claims, yeah. So this isn't some nerdy sidekick anymore, right? This is a significant financial player making serious moves.
Okay, that's a massive volume. So how does that impact the broader financial system, specifically things like the money supply and U.S. treasuries?
Right, this is where it gets really systemic. Stablecoins are, quote, actively buying up U.S. treasuries and money market instruments. They're essentially monetizing government debt, but in digital form. And they don't fit neatly into those traditional M1, M2 money supply measures, how the Fed tracks money, because they kind of bypass the traditional banking system. So this means they're effectively creating a new form of money, maybe making them feel even more like money than your standard money fund. The newsletter asserts that they are not just mimicking money anymore. They're becoming it.
Becoming money.
Wow. And this transformation positions them uniquely within Perry Merling's financial pyramid. That's a framework that categorizes money by liquidity and risk. Stablecoins, according to the source, now sit near the bottom of the second tier, which is usually where bank deposits live. Their emergence there really underscores their growing legitimacy and, frankly, systemic importance.
And the impact on traditional banking. Could this new money start to muscle in on the established players?
Oh, absolutely. They pose a direct challenge to traditional bank deposits, especially if stablecoins start paying yield. You can see a potential mass exodus from near-zero yield bank accounts. It's a huge concern for banks, which is why, as the source points out, U.S. banks are scrambling to create their own stablecoins. Bank of America, Morgan Stanley reportedly launched theirs in July 2025. They're essentially trying to bring this innovation in-house before it eats their lunch, so to speak.
Right. Innovate or get disrupted. Can you give us a real-world example of a stablecoin that shows this kind of scale and impact?
Tether, or USDT, is the prime example. Now, the newsletter provocatively describes it as a guaranteed loss coin.
Guaranteed loss.
Well, the argument is because it's backed by fiat currencies, like the dollar, which are continually being devalued by inflation. That's the source's framing. But despite that very strong framing, Tether boasts this immense user base, over 400 million users, apparently adding 30 million new users every quarter. It's depicted as that duct tape holding together shattered currencies in places like Argentina, Venezuela, Turkey. Economy's really struggling. And get this, from a profit standpoint, Tether apparently pulled in $13.7 billion in profit last year, with only about 165 employees.
$13.7 billion with 165 people.
Yeah, The Macro Butler even quips this makes NVIDIA look like it's running a lemonade stand, just highlights the massive demand and the sheer financial power these entities wield.
Okay, that raises a huge question then. It really sounds like stablecoins are much more than just some crypto niche. The newsletter claims this is the opening act of a full-blown monetary shakeup. What's the bigger picture here? Especially thinking about U.S. debt and, well, global power dynamics.
Right. The timing of that Genius Act is seen as incredibly significant. It arrives just as, quote, foreign demand for U.S. treasuries is falling off a cliff. This decline, according to the newsletter, really accelerated after the U.S. weaponized Treasury holdings back in 2022, sanctioning Russia, excluding them from SWIFT. That move apparently sent a pretty clear message globally about the potential risks of holding U.S. assets.
And how did that play out with major holders like China? They used to be the biggest holder of U.S. debt, right?
They were huge, held something like $1.317 trillion in 2013. But the source says China has ditched $550 billion by year-end and cut its holdings by 30% over 4 years by 2024. And all the while, it's been slyly buying gold on the cheap. The newsletter sees this as a direct response to what it calls U.S. economic hardball sanctions, tensions over Taiwan, that sort of thing. It's a strategic de-risking, moving away from potential U.S. financial weaponization.
But there's a twist, the source says, with the UK's holdings. They've actually gone up.
And it's interesting. The UK has surprisingly leapfrogged China to become the second largest holder of U.S. debt. But the newsletter highlights that maybe 60–70% of these are private holdings and speculates this could be UK investors hedging against the Skarmer government back home. It's a fascinating look at how global capital searches for perceived stability, even amidst these broader geopolitical shifts.
Okay, so if foreign buyers are pulling back, but stablecoins are increasingly soaking up treasuries, what does that actually imply for the U.S. financial system? The newsletter uses this phrase, fiscal QE in crypto drag. That sounds significant.
It's a powerful phrase, yeah. By hoovering up short-term government debt, stablecoins are diverting capital, fundamentally reshaping money flows. The newsletter posits this might even be a carefully choreographed plan, a way to effectively replace the Fed chair, juice the short end of the curve, cut borrowing costs, and let stablecoins do the heavy lifting all while pretending it's just innovation.
Wow. So like QE, but through the back door using crypto.
That seems to be the implication. And the evidence cited. Stablecoins were apparently the third largest buyer of bills in 2024. Shows their substantial role already in funding government debt. It suggests this new, subtle form of quantitative easing, maybe, enacted through private digital currency.
And for you, the listener, how does this potentially connect back to something like inflation?
That's the critical link. Think about it.
Yeah.
More demand pushing investors into riskier assets, lower funding costs for the government because of this new stablecoin demand, and a growing tile of these low-duration, money-like assets circulating outside traditional banking. All of these factors tend to light a fire under prices. So while it looks clever on paper, as the newsletter puts it, it warns it may end with sticker shock, implying a direct hit to your purchasing power. It shows how these technical shifts can have really tangible consequences.
Yeah, sticker shock is something everyone understands. It's almost comical, though, how desperate the U.S. debt situation is portrayed. The source even mentions the Treasury is what? Begging for donations via Venmo and PayPal? Seriously.
It's a pretty absurd detail, yeah. The U.S. Treasury, facing this $36 trillion national debt, reportedly collected a mere $2.7 million this year through those platforms, Venmo and PayPal donations. And the Macro Butler grimly points out that the U.S. government burns through that amount in about 12 seconds. It just vividly underscores the sheer scale of the debt problem compared to these, well, token efforts, highlights the need for much bigger solutions.
12 seconds. Okay. And the newsletter paints a pretty bleak picture of government behavior generally, talking about the 3 acts of government suicide. What are those acts?
It's a grim framework, but thought-provoking. Governments, according to the source, commit suicide in 3 acts. First, reckless fiscal mismanagement leading to inflation to cover their debts. Second, when borrowing inevitably dries up, they resort to tyranny at home and blaming some external bogeyman. And the third act is just outright default and collapse. The newsletter argues the U.S. has just entered stage 2, which is a stark warning about the current trajectory.
Stage 2. Okay. Well, what's fascinating here is how all of this, everything we've discussed, connects back to your investment strategy. The newsletter is very direct with its advice for investors navigating what it calls the chaos cycle. What should our listener be considering right now?
Yeah, the newsletter is unequivocal here. It says the Goldilocks era is dead, gone. It argues the world is shifting into an inflationary bust and potentially stagflation, that tricky combination of low growth and high inflation. So for investors, this means prioritizing return of capital rather than just return on capital.
Hmm.
Preserving your principal, your buying power, becomes paramount in this new cycle.
Okay, preserving capital first. So what's the first, most direct piece of advice for actually doing that in this environment?
The very strong warning. Steer clear of stablecoins at all costs. That's a direct quote. The Macro Butler views them as Trojan horses in crypto clothing, paving the golden road to digital IDs and, inevitably, central bank digital chains.
Yeah.
It's a stark caution, seeing them not as financial freedom tools, but as instruments for increased surveillance and control.
Okay, avoid stablecoins. So what are the reliable hedges then, according to the source, in this chaos cycle?
Physical gold and silver. They're highlighted as the only reliable hedges against reckless and untrustworthy governments and bankers. Described as anti-fragile shields, an eternal hedge against collective stupidity and government hegemony. Assets with no counterparty risk, and crucially, non-confiscable. It really emphasizes their historical role as a true safe haven, a bulwark against state power and financial mismanagement.
Gold and silver. Makes sense historically. What about fixed income? For an investor looking for some safety and maybe a little yield.
Well, the newsletter strongly advises against long-dated U.S. Treasuries and bonds, calls them an uninvestable returnless asset class. Basically, too much risk for too little return, especially duration risk. Instead, for cash management, it recommends short-dated USD investment-grade U.S. corporate bonds with a duration not longer than 12 months. The focus is clearly on liquidity and minimizing that interest rate risk exposure. Keep it short.
Short duration corporates. Got it. And equities. Where should investors be looking for opportunities in the stock market?
For equities, the advice is to hunt for lean, low-debt, high-cash flow champions. Businesses that are ready to thrive amid trends like reshoring, trade wars, and surging defense budgets.
Right.
So resilient companies that can perform well even in a more fragmented, protectionist, and potentially volatile global economy. Companies built for this kind of environment.
Makes sense. Find the strong survivors. Now, the source also mentions fintech, but with a caveat.
Yeah, for investors with a strong stomach for volatility and maybe a touch of cynicism, the newsletter suggests riding the fintech Grady train. It points to the Global X Fintech ETF, ticker FICX-US. Tracks the Global Fintech Thematic Index. Interestingly, this ETF has apparently shown a tighter correlation with the ballooning market cap of USDT than the traditional banking sector, suggesting it directly benefits from stablecoin growth. And for individual stocks, PayPal, PYPLUS, is identified as a potential prime beneficiary of the Genius Act and the coming flood of private stablecoins. But again, higher risk, higher volatility likely.
Okay, interesting connection there. And the classic debate. Bitcoin versus gold. How does the newsletter weigh in on that one?
Pretty unequivocally. The newsletter states that Bitcoin is no more a magical store of wealth than the dollar, euro, gold, or silver. Calls it just the latest contestant on the wheel of financial fortune. Author's very clear. In contrast, gold still gleaming through the wreckage, really reinforcing its long-standing role as that tangible store of value, independent of digital systems or government whims.
Gold over Bitcoin, in their view. Finally, the newsletter ends the section with a very direct philosophy. The fuck you money philosophy. What does this mean for our listener?
Yeah, it's direct. It's a philosophy centered on achieving real financial freedom and independence. The core idea is he who is in debt is no longer free. He is a slave. So the advice is to build a war chest, to amass what the author bluntly calls fuck you money, enough capital to be truly independent of any tyrant, banker, or bureaucrat. It's really about achieving self-sovereignty in a world that seems to be moving towards increasing financial control and uncertainty.
Build that war chest. Okay, so to bring it all together, what we've deep dived into today, drawing from the Macro Butler's In Stablecoins We Patch newsletter, it really reveals that stablecoins are far more than just some tech advance in crypto. They seem to represent a fundamental shift in how money is created, controlled, and deployed. And that has profound economic and geopolitical implications for everyone, especially for you as an investor trying to navigate these changing tides.
Exactly. We've seen how governments might be attempting to patch their own fiscal issues and consolidate control through laws like the Genius Act, how stablecoins are quietly becoming this major force in the U.S. Treasury market, and, of course, the stark advice on how investors might want to position themselves in this unfolding chaos cycle.